All right. Good morning and good afternoon, everyone. Thank you for joining us. We'll get started while a few more people join us on the line. My name is Andrea Armeni. I am the Executive Director of Transform Finance. And as part of our activities, we convene the Transform Finance Investor Network as a learning community for investors interested in exploring the intersection between their investment practice and social justice issues, in particular around wealth creation and distribution. And as we'll see today, focusing now on the issue specifically of racial justice and how racial justice intersects with an investment portfolio. Welcome to all of you. A couple of quick housekeeping things, just because we have switched platforms now from Fuse to Zoom. Please bear with us if there are any technical glitches, but you will see mainly that if you're calling in on a phone, you can use *9 to ask a question or to be unmuted. And if you are on the actual Zoom platform, you have a couple of options to communicate. You can use the Q&A function, and there is a chat function as well that you can direct to the whole group or to a speaker in particular. So we're very excited today to be welcoming Ryan Bowers and Michael Gilmer from Project Activest. And they will be joining us to explore probably one of the things I've been most keen on recently, this odd intersection of racial justice and municipal finance. And I say odd because muni finance is not really something that is so much on the radar of impact investors. A lot more attention, so as we'll see, goes generally to private equity, private debt, venture capital type of deals. But we think that in a total impact investing portfolio activation, there is a lot of opportunities to engage with other instruments, such as fixed income. So one issue is, how this fits within the broader work that Transform Finance is doing around total portfolio activation. The other piece that is of great interest for us is precisely the issue of racial justice. There are a lot of strategies that can be used to drive positive racial justice. Finance, for better or worse, permeates a lot of the racial justice outcomes that we have seen in the United States. So today specifically, we'll be looking at this issue of municipal finance. And really, municipal finance is part of the broader theme of how cities raise funds, largely through revenue for themselves. And I started looking at this a while back when I read this New Yorker piece on civil asset forfeiture, right? The type of forfeiture that cities, as well as the federal government and states can do even in the absence of a criminal conviction. They can seize your assets. And while this seems to be somewhat disconnected from a lot of other issues that we're tackling here, there was this point that really grabbed my attention. And I'm quoting from the New Yorker piece. Many states facing fiscal crisis have expanded the reach of their forfeiture status and made it easier statutes and made it easier for law enforcement to use the revenue however they see it fit. And in some Texas counties, quoted the article, nearly 40% of a police budget could come from asset forfeitures. Again, these are things that are done without any due process under criminal law parameters. Now, when a city decides to fund itself through this sort of civil asset forfeiture, who is it that bears the economic weight of this, right? It's a regressive form of finance. It's not connected to the wealth of the individual that is affected by this in the way that, say, income tax is. And largely, as was seen in the case of Texas, it tends to affect communities of color disproportionately, in some cases vastly disproportionately. So just off the top already, it doesn't seem like a good way for cities to be relying on asset forfeiture, and as we'll see with Ryan and Micah, on fines as a way of raising their budget. There is an intrinsic element there of racial injustice. At the same time, cities do need this money to come from somewhere. Low low revenue for cities and low capitalization for cities has a direct impact on the quality of the good they have. In particular, we're seeing around schools, the quality of the water. And on the flip side, we can look at the way that the city is financed as something that can affect the policies of those cities. So and vice versa. So if a city has particularly poor policing policies, they might be exposed to liability from litigation or otherwise that would impact their economic standing. And conversely, as we'd like to explore with Micah and Ryan, there are ways in which the investors that buy these muni bonds can play a meaningful role to intersect with the cities in the same way as investors are keen to do in the public equities space, for example. So we've seen a lot of shareholder activism. To be frank, we have not seen much in terms of muni bond activism, if we can call it that way. So we'll be looking a little bit at that. Now, these muni bonds for impact investors are really still a tiny portion, even though they are a major portion of an investment portfolio generally. So the recent statistics from the GN report from this year was that only 6% of the total impact assets that are under management are invested in public debt, which is not the same proportion as a traditional public debt allocation within a portfolio. Now, when active, let's say, progressive or impact investors have started looking at their fixed income allocations in the context of impact strategies, they have generally looked at it through green bonds, which we have discussed previously in a webinar a few months ago, looking at some of the hope that there is for green bonds, as well as some of the limitations, in particular around social outcomes that there are there. And I would add to that there is an obvious impact thesis there in terms of adequately capitalizing the cities that are in need of financing. So in the same way as, say, through a, early stage investments in social entrepreneurs that normally don't have access to funding is something that is very much at the forefront investors, there is an analogy there that can be drawn to cities that are undercapitalized, and I'd like for all of us to keep that in mind. And I will add one thing to this that Andrea Benami from Pi Investments had brought up with me: the fact that as an impact investor is trying to improve the impact of a fixed income portfolio, he or she is likely to select for high ESG ratings, right? Going for, much like in other asset classes, for the good players that are out there. And yet there seems to be an inverse correlation between the municipalities that are most direly in need of financing and the ones that are likely to have the highest ESG ratings, right? So if you were selecting for ESG rating, you might end up being overweight, so to speak, on Newport Beach, and certainly underweight in Flint or in Ferguson. And I want to tie this back to another conversation we've been having with Investor Network on that issue of impact measurement. That is, whether you are looking at your portfolio in terms of moving capital to recognize the positive outliers versus moving capital in ways that can actually support the improvement in the impact of other investees, whether they be entrepreneurs, funds, or in this case, municipalities. So with that said, elements. We've been looking at the work of the Refund America project out of the Roosevelt Institute with Sakib Bhatti on the issues that that Puerto Rico has faced in its bankruptcy, and how the investments that the muni finance that came into Puerto Rico was really structured in a way that was really not quite conducive to driving a healthy fiscal landscape for the island. There is another element that also came out of the Roosevelt Institute, this Forgo Wells campaign that they started, that is not necessarily connected to just to the cheating of customers, but also to the fact that cities play a particular influence with respect to the various banks that could be doing the investment banking function of bond issuance. And if there are some that are particularly bad players, or if there are some that are particularly good players, that should correlate to the to a city's choice to reward a bank for what it's doing. So I would encourage you to look both at the Refund America work and the Forgo Wells campaign. And in terms of this Muni finance being in some ways, or let's say bond finance being a driver of economic injustice, Kathy Clark from the Duke Impact Initiative brought up to me this tremendous study that was done at their business school on how historically Black colleges end up paying higher costs in the bond market, which is a very, very unfortunate finding. This from a few months ago. I'd encourage you to take a look at that as well, and we'll be happy to share links at the end of this. Two last things. This piece on Muni finance that we're doing today with Activist is part one of a part two exploration. Please stay tuned. In late January, I believe, we'll be doing the second piece with Neighborly and HIP investor around some other opportunities for getting more engaged with municipal finance. Now, last thing with respect to the work of Transform Finance within the investor network and more broadly, is this issue of how, as an impact investor or an asset owner, say that you are a particularly progressive foundation with an interest in equity and in racial justice on your grant side, how can you advance these racial justice outcomes out of your endowment, or as an investor out of your investment portfolio generally? And we look at it in this sense of, where does race show up in your portfolio across all asset classes? What are some of the impacts on racial justice that come from your public equities, for example? Is it limited to the representation of people of color in management and on the board of the corporations of which you own stock? Or does it also go, for example, to the tax avoidance practices of many of the public corporations they might be holding, or the quality of the jobs that also impacts disparately people of color within your portfolio? So this is the broader project that Transform Finance is looking at. And I'd love to put out the question for you of what would be helpful as an investor that cares about racial justice for you to know in this context. What would be the right analysis that would help inform your practices, and if you have a sense of what the appetite would be for this kind of investigation. So if in any way you're interested in this topic and this project, I encourage you to get in touch. My email there is andrea@transformfinance.org, and we can discuss this further as the project develops. But now I would love to introduce Ryan Bowers and Micah Gilmer from Activest, that are going to lead us through this exploration of this intersection between municipal finance and racial justice. I'm gonna share the remote control with you, Ryan. Ryan and Micah, thank you so much for joining us. And Ryan, I see you are on mute, but go ahead.
Thanks so much, Andrea. I'm gonna kick it off to Micah to get us started.
Awesome. So I want to just walk through a little bit of our agenda for today. We'll tell you a little bit about ourselves to start off and how we got engaged in this work. Then we'll talk a little bit about the problem that we see in terms of some of the challenges in this arena. And then we'll talk, Ryan will lead us through talking specifically about the market failure component of this, the way that the municipal bond market is currently not adjusting for the risk of poor municipal policy. And then lastly, we'll talk about our model and what we're seeking to do together as part of the Activist team. So just a couple quick words of background on us. So we are, Ryan and I have been working together for over a decade at Frontline Solutions. We're a social impact consulting firm that does strategy work, that does evaluation, that does work with folks across the country are looking to improve the quality of life for folks in this country. And as a result of that work, we've really gotten a unique opportunity to connect with folks across this country. So we work with folks from grassroots activists on up to foundation professionals, folks that are working in local government, folks that are working in state and federal government. We've really gotten a really wide mix of folks to connect with. And over time, our firm has built from being just 3 folks, myself, Ryan, and Marcus Littles, who's not on the call today, to now having 10 full-time staff, about 50 staff in total, and a really strong national footprint. And so we worked to launch the Executive Alliance for Boys and Men of Color, which in turn helped launch the My Brother's Keeper initiative at the White House. And we're connected to a network of 24 of the foundations in the country that care about racial equity and racial justice, and those CEOs. Ford Foundation, Robert Wood Johnson Foundation, W.K. Kellogg. I mean, a huge list of most of the folks across the country that are working on these sort of issues. And so the idea for Activist really started for us a couple years ago. We were called in right after the century of Michael Brown to think about, with folks locally, about what the right sort of rapid response investments for philanthropy should be. We found what was really interesting. One is that obviously, the social unrest that city was experiencing was not just the result of the incident and then protests after it, but really were underpinned by deep and real divisions along issues of race and class in that city's history. And what we found very early on, as we talked with activists on the ground and arranged a few meetings with folks, that there was something really unique happening in St. Louis County in general, in terms of the ways that people of color were being policed in those places. And so as we talked to folks with the Deaconess Foundation on the ground in St. Louis, as we work with national and local activists, we really came to have some really clear ideas about what the fundamentals of the problem were. And Ferguson in particular is a place that had experienced some pretty rapid transition, like many suburban areas in this country, as folks, as a sort of economic base or middle and upper middle class folks look to get back into the city. Many of these suburban areas are experiencing what essentially, tantamount to the sort of white flight epidemic in the 1960s and 70s in reverse, so that these suburban areas are becoming increasingly Black. In the case of Ferguson, became 67% Black. And that with that is the erosion or the decline of tax bases to those cities. And by the way, as we are talking to advocates and analysts about the Trump era, we imagine that some of these revenue shortfalls for cities are going to become even more acute as sort of federal block grants give states more discretion in terms of spending, and maybe less funds trickle down to cities. So these revenue gaps that cities are experiencing, many of them have chosen to fill those gaps by sort of fines, fees, and forfeitures, which Andrea talked about a little bit earlier from the forfeiture standpoint, but also fines and fees for things like jaywalking, failure to comply with citations. And so what that meant in Ferguson was that 90% of Black residents of the city of Ferguson had fines and fees, and 20% of the city budget were accounted for by fines and fees. And even more shocking in many ways, 75% of the population of that city had outstanding arrest warrants at the time of the death of Michael Brown. And so if you look on the next slide, one thing that we found to be critical to our understanding in terms of this work is just this idea that this is not just a Ferguson problem, this is a national problem. So literally across the country, there are $50 billion of outstanding fines across the country, fines and fees, and it's a growing national trend. So 80% of probationers and 30% of those sentenced to jail are asked to pay some sort of fee. And literally 47 of the 50 states in the country have increased the levels of their fines and fees since 2010. And so just to give you another notable national example, Philando Castile, shot in St. Paul, Minnesota, literally was the 49th time he had been pulled over by police. And the Department of Justice, and Ryan will get at this more, has actually drawn the link explicitly between these increased and aggressive policies around fines and fees in cities, the impact that has disproportionately on Black folks, Latino folks, and other folks of color in cities, and the ways in which those policies are tied to the financial pressures and the fiscal policies that those cities are enacting. So Ryan's going to talk a little bit about just the market failure that Ferguson represents.
Great. Yes. So when we first got involved in this work, one of the interesting things that we noticed, as we were working with philanthropy, advising grant makers on rapid response grant making, was that as progressive folks were kind of making change on the ground and working with activists and organizers, we saw that the financial markets actually started to pay attention to what was happening in Ferguson at the same time as well. And if you can advance the slide to the market slide, thank you. And go one more. Great, thank you. So what you saw in Ferguson was as the Justice Department's report came out, one of the things that they found was that all the aggressive policing was really driven by Ferguson's desire to revenue. So they were using fines and fees as a revenue source. And interestingly, right immediately before the report came out, Ferguson actually had a great bond rating. And so it was, the ratings agencies were responding kind of after the fact. They were waiting until there was a financial event to downgrade Ferguson's debt. And so one of the things that we noticed is that kind of immediately before the consent decree came out and investors could start to quantify what the cost would be to implement some of those reforms from the Justice Department, Ferguson was in great financial standing. And then you see automatically after that happens, their bonds get downgraded kind of 7 notches to nearly junk status. And so I think it's an important thing to note that from an analyst perspective, Ferguson's bonds, they were kind of, everyone was watching this kind of slow train wreck happen. But the ratings agencies kind of waited until really after the fact. They kind of took a more kind of conservative approach to, making a judgment or making a downgrade. But this was something that if you lived in Ferguson or if you were doing advocacy or organizing work there, you saw this happening. They were living with this for 3 years before that. So it was really a kind of delayed effect from the markets in terms of how they responded and how they kind of corrected for some of the social practices that were going on in the city. Next slide, please. Great. I want to talk a little bit about some of the municipal bond ratings. And so, we talked to Moody's, we talked to their analysts about what the response was to Ferguson. How do they really factor in these things, and how do they look at their downgrading that happened there? And so we started walking with them through kind of the ratings attributes and what goes into their methodology. And one of the things is that the ratings agencies, they use really kind of cutting edge leverage ratios. They're looking at the tax base. They're looking at debt coverage. These things that are kind of traditionally and really accurately tie into the financial health of the city. And so they can make some really great predictions based on kind of standard financial practice. But one of the things that they're clearly not really looking into is the kind of how are these social practices kind of tied into financial outcomes? How can social practice kind of be of the long-term health and viability of a place? And that just doesn't really show up. Internationally, the best analogy is really country risk, but we don't have a framework to catch that domestically. So one of the things that we're hoping to do is when Warren Buffett invests in a company, you see kind of follow-on investment. He's kind of a bellwether for what kind of follow-on investors might look like. And we're trying to do the same thing in municipalities to say, how can we get ahead of this and not just respond to what's happening in cities? Great. So here's some examples. There's a few things that credit ratings agencies aren't looking at, or they weren't looking at in Ferguson's case. So one thing at one time there is. So this source, if you look at their annual financial report, Ferguson and a number of cities in St. Louis County and around the country that are using fines and fees, that are using civil asset forfeiture to raise revenue. These are not consistent revenues. You can't count on this as an ongoing revenue stream, and that's just something that isn't really on the radar right now of ratings agencies. Another thing is kind of the undermining the economic tax space. So civil asset forfeiture, fines and fees, a number of other practices of aggressive policing, they start to really strip assets of your residents. And so that's not only that's bad for your city in terms of your long-term viability, your people's ability to pay taxes, especially if people are kind of living, paycheck to paycheck. And we know that, Americans today we have kind of on average a negative net worth. And so there's so many communities that are kind of living on the line. So many people, you're one check away from losing your job, not being able to make your car payment, and not being able to kind of get to work. So it's undermining the tax base. And then you look at likelihood of lawsuits and social unrest. And so this is everything from the uprisings we've seen in Ferguson, the uprisings we've seen in Baltimore, the lawsuits that come from engaging in these practices, engaging in practices that folks are going after, like money bail and civil asset forfeiture and fines and fees, and so many other forms of policing and using cities and municipal courts as revenue centers. And so as if you're kind of doing an analysis on a corporation and you're going through their financial reports, you might be looking at pending lawsuits, but it doesn't tell you the likelihood of, for a municipality, the likelihood of getting a lawsuit from the ACLU or the NAACP Legal Defense Fund, because you're engaging in social practices. So that's not on folks' radar. That's something that we really want to lift up and bring some visibility and transparency to the market in. Great. And so, this isn't, at the end of the day, it's not just about Ferguson, and it's actually not just about fines and fees. We're really hoping to kind of put on the map all the places around the country, as we see the suburbanization of poverty. We see kind of communities of color moving to smaller and rural cities and smaller towns, and some of those sheriffs or city leaders not knowing how to respond, or kind of responding in probably some of the worst possible ways. Really kind of giving people ammo and a framework for thinking about some of the changes in demographics that we're seeing in cities, and also some of the kind of negative practices and responses we're seeing from those elected officials and leaders. And so we talk about Flint and what they kind of some of the gamble that leaders in Flint took to try to save a few dollars in costs on their water bill. Actually ended up, now it's going to cost over $400 million. And we've seen some of the same issues with Baltimore, a city that's kind of dealt with overpolicing, that's had some of the kind of the worst data on the interaction between police departments and the number of, Black males that are either on probation or parole or in jail. And the uprising that happened there, and now Baltimore is taking another gamble based on one of their biggest debt issuances in history, really in Baltimore's history. So I think an important thing, and Andrea mentioned this early on. We're not saying this, or we're not making a case to kind of divest from cities. We're not making a case to just to turn away from them. And use this as a way to screen out cities that are struggling from your portfolios. That's really not what we're trying to do. And I understand that might be some people's response. We're actually making a case to double down, and how do you invest in these places that people, all of us as investors and all of us as stakeholders are rooted in place. And so how do you think about place as a way to double down and not just, cut and run, but actually engage actively with cities? And we've seen examples of shareholder engagement in the corporate side, And you've seen resolutions, we've seen, we've seen takeovers. And so it's a very different framework in municipalities because you're not an owner. You can vote, you can go to the ballots every, the years. But we would love to give kind of ammo and opportunity between them. I think it's an important thing to note in the municipal bond market. You see, there's over 40,000 municipalities, and over about half of those are probably rated by the ratings agencies. But there's the long tail. The majority of municipalities aren't seeing a ton of action in terms of the number of issuances they're doing. So kind of maybe that's happening. Maybe your city is issuing bonds only every few years, and analysts that Moody's and Standard & Poor's are putting on them to look and analyze those cities. They're just looking at the annual financial reports. They don't have a lot of nuanced data of what's happening on the ground. And so we're kind of making a case to say, how do we find out what's going on in our cities between those periods? Not just when there's an event or after an event, but between issuances, between activity, to really know for the financial implications, but even more importantly for the well-being of our cities and really around the health of our democracy.
Right, if I may, while we're still on this slide, in the context of Baltimore, I think that's the perfect example for the type of analysis we are suggesting, because off the top, the $1 billion issuance, if I understood correctly, is based on a foreseen increase in tax revenue that would come from this increase in value, right, in the property taxes that would derive from increasing value from this $1 billion investment. Can you tell us a little bit more about how that fits in this context and the degree of analysis really that is required to be able to tell whether this would be a positive or a negative? Be mindful that many of the investors that are looking at these potential muni bonds don't really have access to that degree of information.
Yeah. Yes. So when you talk to people in Baltimore, I don't think there's so much of a disagreement of whether you'll see the increase in property from the TIF and potential revenues from that. I think the bigger issue that is worth looking at and kind of interrogating in Baltimore and other places is the degree that these investments, the degree that these cities kind of taking on debt and taking on risk, that they'll benefit all citizens. So it's a risk that the city takes on collectively, and you want to make sure that the benefit to the city is consistent and not outsized by a smaller population. And so, I know the question in Baltimore is, how does that investment in the Port Covington area benefit all Baltimoreans? And how does that not just kind of primarily get reaped to, a smaller group or really just private investors? And if the city is going to take on that debt and that risk, how does that benefit really accrue to the city and the residents of all Baltimore?
Yeah, and put another way, I don't think we're really quibbling with the upside opportunity that presents, but it's really that the unaccounted for downside risk of displacement, dislocation, further inequity, et cetera, in the city, what that creates in terms of increased social unrest, et cetera.
Right, and this is the fundamental aspect, I think, that was of great interest to us based on the general emphasis on who really benefits from a lot of these investments. And it's not a fine enough lens to say a city would benefit from this. If I'm understanding correctly, you're putting the emphasis on saying, well, who within that city, how well is it distributed, precisely because the risk is shared among all the citizens, right? And in fact, if anything, is skewed towards those that are less likely to benefit from this, whereas the return from this would be towards the wealthier portions of that city. So it's in the frame that we use at Transform Finance about fair allocation of risks and returns among all the stakeholders. This seems to be a perfect example of one of the things that one should be looking out for, right? Where is the risk of a TIF like the one in Baltimore, where is that landing, and where is the benefit of that being reaped by, in this case, I imagine, private homeowners and developers?
Yeah.
Thank you.
Great. So yeah, we've talked a little bit about the problem, and beyond just fines and fees, beyond criminal justice, but some of the challenge of having visibility into the social practices of city and knowing kind of the relationship between that. And really, it's kind of talking about the social determinants of municipal health. And thinking about, all right, so we have an understanding of the problem. We have an understanding of what the role of the capital markets in terms of how they conduct business today. And we're going to talk a little bit about some of the opportunity to kind of bring some lessons from shareholder advocacy, bring in some lessons from our work with kind of community advocates, grassroots organizers, to really kind of put what we hope together is a first step towards a solution that we haven't really seen before. Great. So we're really excited with Activist to really bring together these kind of two traditions and kind of realms of work. The tremendous opportunity to work with investors and to really move markets in some way. It's the municipal bond market is a $3.7 trillion market that investors are really investing in because they want that tax advantage for particularly high net worth individuals, and they also invest in municipal bonds because they're safe. It's generally a really safe, low risk asset class, and I think we have an opportunity to not only to make it an opportunity, not as something that's just safe and something that's low risk, but as a way that really truly brings benefit to the city, a social benefit. And I know that's the reason why investors get their tax advantage. But we want to really figure out how do we marshal and use the leverage that we have as investors, since we're all investing in municipal bonds, to really push our cities to be the best that they can. And so we're kind of bringing some data and also some intelligence to funds, investors, and even municipalities eventually to marshal them as advocates. And at the same time, work with the groups that we've been working with for over a decade, activists, advocates, legal advocacy groups, to bring them kind of financial intelligence and policy research to help arm them as they're going up against juggernauts. They're also oftentimes making a moral argument for cities to change and for city leaders to pay attention to these issues. And so as sometimes that moral argument isn't enough to bring people to the table, we know that if you can make and when you can make a financial argument, sometimes you get significantly more mileage. And so how do we kind of resource these groups to do that work and take it further than they have? And we see our work with investors as really being kind of the fuel in the tank to kind of really kind of pay for and subsidize kind of the impact that we see happening with kind of grassroots advocacy work.
Great. And one thing, Ryan, that we can perhaps tackle later, but came through in a question from Morgan Simon, was a comment around the fact that a lot of the investors in this space get into muni bonds largely through sub-managers. So step one would be really to identify which ones are the players that need to be impacted by this information, whether, to your point, is on the financial case or more on the social case for this change in practices, identifying them and figuring out how to get to them, and we'll probably cover that. And in that context, I wanted to advise everybody who might be calling in instead of joining us through the Zoom platform. To ask a question, you can raise your hand, so to speak, by pressing *9 on your phone. That should work, and we can unmute you on our end. Thank you.
Great. So yeah, there's a number of things that we're hoping to provide to investors, and I'll get into this a little bit more later on in the presentation. But you know, we are kind of at the point where the ship is taking off, and so we are starting to work with our first customer, which we're really excited about, and working out the details of that deal. But the things that we're providing are data and research on municipal practices, the social practices of cities, and Michael will talk more about that in a second. Both social science data, but also kind of indices and rankings and ratings of those municipalities. We're also providing portfolio screens to funds, to investors, to really look through their portfolios to figure out, right, are they investing in line with their values and the impact that they want to have. So you don't have, you know, even foundations. So you don't have one side of the house kind of undermining the work of the other side of the house, as you know, you mentioned, towards the goal of total portfolio activation. And then the last thing is we're raising a municipal bond fund, and it's kind of more of a longer term strategy, but to actually have our own kind of investable vehicle for folks to invest in. So if you can move to the next slide.
Will you tell us a little bit more about the idea behind that fund?
Yeah, that yes, it's a couple things. You know, one of the things that I guess we've, you know, I think there's some ability to really curate a kind of customized portfolio of investments that you know, long term we're hoping that we can use that to drive investments towards cities, as I talked about kind of doubling down earlier, drive investments towards cities that are starting to make improvements and gains on certain practices. And so if we're, you know, as we have our index up and we're starting to monitor cities on their, you know, where they're at, and they don't have to be in an A+, but we want cities to move from a D to a C or a C to a B. And so as cities are making that progress, that we would be able to have a strategy that drives investment there and drives investors that kind of care about those places and are rooted in those places. And our goal is that for some of the returns of that to be able to be rerouted back to organizations and advocates doing some of the work on the ground.
And I think to your point, Andrea, earlier in terms of the sort of activist shareholder model, that fund ultimately is sort of the tool that we could use to leverage that, right? So that we would make our own investments and sort of have positions in cities that would be significant enough to sort of have a seat at the table in terms of the conversation, and then also to bring other investors along with us that share our values and would care about the same sorts of issues in cities and other municipalities.
Great. So there is at least a dual strategy. One is the intrinsic fact of moving capital towards these cities, and the other is that active role that you would take in driving the improvement processes for the cities.
Yeah, and I think just the synergy and the ability to unlock this energy between investors, the potential that they have, and those that are really kind of morally and socially invested in using their dollars to bring about change in communities, and the work of folks who are doing organizing and advocacy work across cities. I think those two groups have been, you know, they haven't traditionally seen a lot of coordination, particularly on the municipal side. And I think there's just a tremendous amount of opportunity to align align that work and align those interests and really see kind of a flywheel happen in terms of advancing everyone's progress.
Yeah, I mean, this is a market that doesn't have an exemplar investor, right? And I think that's the space we're looking to occupy, both from a fund standpoint, but also from an advising standpoint.
Terrific. And we have a question asking for a bit more information on the portfolio screens that you're coming up with. Feel free to tackle it whenever the right moment comes up. I just wanted to put it on your radar.
Yeah, I'd love to dig a little more into some of the methodology before we get to that question. Yep.
Great.
Yeah. Great. And so So this, this is an example of just some of the kind of stakeholders that we think will be important to engage, just some of the categories from, some of the pension funds, and there's folks that have a history. We talked to a couple of people at SEIU that are already engaged in shareholder activism and have a great track record in that. Progressive investors, there's a couple there that I've seen before, Transform Finance, and Regenerative Finance, and so many others that are kind of mobilizing kind of constituents to invest smartly, but also invest impactfully. It's not, this work isn't about the innovation, it's about what impact can we have at the end of the day. Philanthropy, traditional philanthropy, that are kind of some of the folks that are kind of leading the charge on impact investing and using both grant making and also using the rest of their endowments to responsibly in cities and in places. And then also kind of larger traditional investors that are kind of buying up the majority of municipal bond issuances. If you can see change with, Vanguard or, Fidelity or even kind of Goldman or BlackRock, they have so much potential to really change the paradigm by which, billions of dollars or hundreds of billions of dollars are directed in communities, and what that means for cities. Great. So this is kind of connecting, the as is with what we hope to be in place. And so, yeah, you're seeing here, right now investors are investing in the municipal bond market, and what we've heard and seen is that a lot of that investment is just ought to be inherently impactful because you're investing in cities, and in the worst case scenario, what we're seeing is kind of enabling some of the ongoing practice, or kind of not fully exercising kind of our kind of rights and responsibility to know what we're using our dollars towards, and to engage some of those cities. I mean, as transparency and visibility comes up with corporate investments and corporate shareholder practices, we see kind of a tremendous response there. And kind of the rightful kind of outrage and active engagement. And we want to encourage that same practice with cities. And Micah, do you want to talk about kind of where we're taking this in the future?
Yeah, and I think the real sort of unique value add is the connection of that work in terms of better informing and better mobilizing the investor community with the work of sort of advocates that are working towards better policies on the ground. And so how do we connect those two conversations in a meaningful way? Frontline in our work nationally has really served as that sort of translator or bridge between these different types of knowledge. And so we're seeking to do something similar here, both in providing more information. There's a lot of, and the folks that are advocating change on the ground, a lot of misinformation. There's a lot of conspiracy theory. Sometimes we can provide some actual real data for folks to help guide and ground their work, but also to provide a different sort of lever for change that they currently don't have access to. So on the next slide is just some examples of all the different kinds of data we'll use. It's a little bit, I'll apologize in advance as we're waiting for it to pop up. It's a little exhaustive. And part of the reason why folks haven't really done this work is because, all of the things that impact the financial health of the city are obviously really complex. And it's not a simple thing where you can get sort of three, key indicators and plug and crank out an algorithm that we can use. We really have taken an exhaustive look at all the different things that impact financial health and racial equity in cities, and we're interested in all of those pieces. The thing that we're able to do is to rate both the social impact relatively the social impact of each of these pieces, as well as the sort of fiscal impact of each of these pieces. And I think pair that then with on-the-ground data. One of the challenges of most of the available data in these areas is that it's definitely lagging data, right? There is not real-time, highly effective, highly available quantitative data in these different areas. And so one thing that we're uniquely positioned to do is to pair this quantitative data with qualitative information from our partners on the ground in terms of what's happening in real time. And so that we're able to see those data indicators that point to that, but also the real-time impact of new policies that are being rolled out.
And maybe, Micah, on this slide, you can give a little bit more color for the ones that are not on Zoom, that are calling in on the phone, so they have a sense of what's being shown.
Oh, sure. So, we really have looked at sort of 6 key areas. One being sort of finance. So, what are your tax policies? What are your tax increment financing position? Criminal justice issues. So, how much is the city relying on these one-time revenues that we talked about? These civil asset forfeitures, these municipal fines and fees, things that we know lead to folks being incarcerated, which has financial costs, even if it produces short-term revenue. Public health, so what are the access people have to have quality healthcare that we know impacts their productivity as citizens, things like lead levels, water infrastructure, and things of that nature. In the education space, looking at school discipline and school push-out policies, where we have some really key partners that are really drawing the line between discipline policies that push kids into the prison system and out of schools, and the way that impacts the long-term financial health of a place. And governance and democracy, just sort of what is the city's sort of nepotism and conflict of interest policies? Does it have strong governance that leads to the best ideas being adopted? Is there transparency in terms of data? Can we trust the data? The data highly biased and suspect that a city is producing. On the housing and land issue, just things around sort of gentrification and displacement. Where are these new tax revenues coming from? What does it mean in terms of citizens that are being displaced to other parts of the city and at times getting disconnected from jobs and services and other things that we know lower income citizens need to be able to survive. And so those are all just a sort of, quickly, just sort of the sorts of indices that we'll be looking for. And I think for each city, there'll be, these things will be weighted differently, right? So in different places, different aspects of these components are critically important. And part of our job is to sort through this, have an understanding of how these things fit together, pair it then with the qualitative data, and then and be able to give solid advice in terms of the overall financial picture or financial health of a city or another municipality.
Fantastic. And an ancillary question that came up was around environmental justice screens that you might have. I imagine that's partly covered by the public health piece, or how are you seeing environmental justice fitting in this?
Yeah, I think that's core to the public health component of this, right? And so again, when people, a very simple analysis of a city, it's about cost of things like, waste services, et cetera. It's all about costs, right? How do we manage costs? But the environmental justice impact of those things is absolutely the kind of things that we're interested in and thinking a lot about. So in this slide are just a sense of just some of the organizations that we've worked with. And so this is everything from, national policy think tanks like PolicyLink, which we have a really close relationship with, next generation civil rights organizations like Color of Change, the ACLU, Advancement Project, and also local advocates like Dream Defenders, who are working in Florida in a particular context in 4 or 5 cities and counties in Florida, to help them think about what this means in terms of local policy. And so again, the idea here is a two-way exchange of information, right? That we're providing them with information about the fiscal health of their places, and they're also providing us with on-the-ground data and on-the-ground analysis in terms of mobilizing folks around a city that's more inclusive, that's more racially equitable, and that leads to better long-term financial outcomes for everyone.
Wonderful. Let me give you another question that is coming in, if you don't mind. Whether you're from the Boston Impact Initiative, whether you're working with any impact investors at the moment on muni bonds, and what is the range of those investments or allocations?
Ryan, you're on mute, I think.
Yeah, great question. So we are kind of just in some exploratory relationships with investors on muni bonds. You should definitely reach out to us if you're kind of doing that work. We'd love to hear what you're working on. But so yeah, this is something that we're kind of in the process that we're still building.
Great, terrific. And if you don't mind, there is another question around how the Activist Shareholder Bottle would generate a return, which I understand goes a little bit beyond the scope of this webinar, but I think we can address it in terms of how well there would be a de-risking mechanism, right, to the work that you're doing, and part of it, I imagine, reconception of what a return ought to be for an investor into space?
Yeah. So there's certainly the reducing the downside risk and de-risking your portfolio, and looking at, as we're going through our data and doing our kind of statistical analysis, one of the things that we're looking at is not only the data, but also the kind of causal relationship between that data. So how do certain social practices correlate to financial outcomes? And also we're kind of layering on top of that kind of social policy theory, and social science theory. So as we're working with anthropologists, sociologists, ethnographers, economists, to look at, all right, what are the kind of extant social theories out there that apply to how wealth development and asset building happens on an individual and a community level, and seeing the interchange and interplay between those things. And so that our goal is to actually develop some kind of predictive models, and so that you can start to see what are some of the early warning indicators of health of cities and how are they on track in terms of their social practices. And you can see this really clearly in, for example, within a school district. So if you're if you have school district bonds in your portfolio, it's not only looking at the outcomes on the back end of student performance, but it's also looking at what are the practices that we know are evidence-based, that we know have been kind of rigorously tested, or we know that we have kind of an early the canary in the coal mine through our relationships with on the ground, teachers, organizers, educators, local education, newspapers, et cetera, that give you an insight beforehand, as these issues are kind of growing and before they actually blow up and turn into a Ferguson.
And I will add to this, for the benefit of the members of the investor network, this strategy seems very much aligned with a lot of the work that we're doing generally, and specifically some of the work around the issues in renewable energy, around human rights that we have brought up in this community before. As you might recall, it was through the work of Sergio Oceransky of Grupo Llanza, both in Mexico and then in Kenya, that we came to know about a lot of issues that were completely off of the radar of some of the investors, including the institutional ones that had done the due diligence on the social aspect of these investments, and according to whom it seemed like everything was fine. It was just through that deep relationship with folks doing the real work on the ground that it was possible to lift up some of these issues and tackle them. And I'm applauding the fact that Activist is also using this as a strategy. There's one question here. Oh, Mike, I see you have answered it. Maybe you can give the very quick overview for the folks that are not on the platform. Question is around whether this will include finance for county governments, which is particularly relevant in rural areas. Thanks, Micah.
Yeah, we're interested in both counties and cities and other municipalities. I mean, one of the challenges, and Ryan hit on this earlier, is that smaller places tend to do less bond issuance in general. They tend to not be rated, and they tend to have less trade volume. So those are all sort of challenges. The flip side of that, though, is that because many of these smaller places are not doing this very often, but are smaller markets and smaller issuance, there's really an opportunity to, I think, have an impact on some of these smaller markets potentially. So I think we're very much interested in that and still exploring what that would look like.
Yeah, materiality looks a lot different when you're talking about, St. Louis or Tulsa versus New York City or even Baltimore.
So there is a sweet spot for you in terms of the size, at least for a first round of cities that you'll be looking at?
I think so. I think so. I think there's a sweet spot in this kind of mid-level. But at the same time, though, I think there's also an opportunity to engage in some larger places to start to tie the social and the financial together. So, example, you got Chicago public schools that are kind of teetering on kind of bankruptcy now, and you have huge hedge funds that are investing there that don't necessarily their primary goal isn't to have, Chicago public schools, their kind of social and fiscal health, long-term fiscal health in mind. That's not their kind of investment thesis. But how do we kind of engage a place like that to bring a new lens for investors to not just screen them out again, but also to kind of push for change? And so how do you bring together the trustees of your pension fund, the trustees of your foundation's funds, endowment, together with kind of union leaders, educators, local stakeholders, city council people, to push for change and use ammunition you didn't have before, that you didn't have apart, that you do have together. So I think there's actually opportunities in some bigger places where there might be kind of more, that there's kind of mobilized audiences. And some of that depends on place to place where relationships are. But I don't, I think there's a kind of argument for a middle, kind of mid-sized market, but I also think there's opportunities for bigger places as well.
Wonderful. And as you move over the next few slides, Micah and Ryan talking about the traction and the steps moving forward, I want to set you up with a question that came in offline, which is probably the best question you could get, which is fantastic work. How can we all support you? Are you looking for grants? Are you looking for equity, clients, partners for testing, information? So as you move through, I just want you to, wherever you think it fits best in your presentation, feel free to address, how can this group support your work?
Great, thank you. So I just wanted to give people like very kind of transparent sense of kind of where we've come from, where we are. So, we did a kind of soft launch in August, wrote an op-ed with Next City magazine, and kind of, put out a very small kind of website. But the idea was to kind of dip our toe in the water. And honestly, on a really personal note, it was the frontline partners. I remember we were all sitting together in Baltimore, and we were having a retreat when it was the day after the news came out about Alton Sterling and Philando Castile. And I think for us, was one of the things that kind of further galvanized this work, kind of how important it is. We are kind of fielding phone calls from our colleagues that are doing kind of organizing and kind of managing and coordinating some of the advocacy response across the country. And I think that was, as we've been engaged in this for a while doing this research, but I think that was another point where it kind of hit home that, we are looking for partners. We're looking at ways to accelerate this work and to deepen our impact. And if we want this to be a sustainable model, and, we do need, we're looking for investment, both kind of grants and investors to help fuel this. But we're really looking for kind of partners and colleagues that kind of can maybe catch this vision and see a new opportunity to push and invest and improve cities in ways that we haven't been able to before. So we're really excited about kind of where we're at. We're trying to go into this eyes wide open and realizing that we don't have all the answers, but we have some great people around us and partners that are kind of, just brilliant investors. Some folks who are doing some cutting edge civil rights work, legal advocacy work, some social science research at different academic centers and partners, that I think that together we'll be able to do something that, I don't think we've seen before. So I would say, and then looking forward, so we're working on, we're still doing some data testing. We're finalizing this first round of data, as Micah showed you what that data map looked like. And we're also kind of doing some fundraising around our infrastructure and kind of operational costs. Excited to figure out what a city-specific strategy looks like. And also we're kind of beginning the early stages of kind of raising this municipal bond fund that we're really excited about. But, for us, and you can advance to the last slide as well, we really want to hear from you all as kind of listeners and folks who have been involved in this work as investors, as advocates, and wherever you see yourself on the spectrum. What does this mean to you? Are we on to the right track? what are ways that we can kind of sharpen our analysis? What are things that we're missing? And what are really opportunities for impact that we should be thinking about? Love to hear from folks around kind of feedback, how to strengthen this, and how we can help make this not just something that's kind of innovative, but something that is kind of deep and meaningful in the communities where we all care about.
Yeah, and I'll say too, because some folks have asked that in the chat function as well. We're open for business, and so we're very interested in connecting to you all that are doing investing and want some help thinking through where you're investing, and also how do you sort of leverage and increase the impact of those investments in cities and places.
Yeah.
Great. Let me bring one more question, if you don't mind, from Lavasti and Glenn. How can this level of screening for cities for investments help to inform grant-making strategies for foundations in those geographies? And you see yourself consulting with foundations and with activist groups around this?
Yeah, consulting with foundations is the thing that we know how to do best. So we're figuring out some of this other stuff. But yeah, I mean, the analyses that we're doing in places, I think are just a different lens and a different way of thinking about some of these impacts, and also connecting the dots for some of our place-based funders between a lot of disparate things they're doing around education and healthcare, et cetera. And so yeah, that's very much in terms of some of our existing clients that we've been talking to about some of this new work that we're doing. That's something they're very much interested in, is how do I think more comprehensively about the health of my city or my place, and how do I also use it as a tool then as I'm engaging with local leadership.
Yeah, and there's even really excited to work with some foundations that are kind of on the vanguard of using their endowments and through PRIs in new ways, and of thinking about kind of activating their kind of fixed income and municipal portion of their holdings to really kind of push in these cities. And so, yeah, really excited about that, excited about the kind of convening power and position of foundations in these places as they're kind of touching other investors, touching municipal leaders, and really an opportunity to, I think, shift the conversation in a new way.
Fantastic. Well, thank you both so much. I'm just doing one last round to see if there are any last outstanding questions from participants. And meanwhile, I'll take the occasion, both to applaud your work. This is spectacular. It is, to your point, Ryan, it's innovative, not just for the sake of innovation, but because we need something new in this space. And this seems to have a tremendous amount of promise. And from both the Transform Finance Investor Network perspective and the Transform Finance perspective as a nonprofit organization, it really fits remarkably in the context of our exploration of this intersection of racial justice and investment portfolio, in particular, frankly, in the case of foundations that on the grant side are aligned with this. So I do invite everybody to be in touch with us on the racial justice screen piece, and also to sign up for the upcoming webinar. You will receive an invitation to explore what Neighborly is doing in terms of providing opportunities at the retail level to invest in communities, and HIP Investor around some of the ratings that they're doing in this space. Any final thoughts from you all?
Yeah, I would say if anyone has any more technical questions around kind of duration and yield, would love to, feel free to send them our way. We have folks in our team that have much deeper kind of bench and experience as former traders and investors. And so I can try to respond to some of those, but also kind of get those to people with significantly more industry experience. But yeah, really excited. Appreciate the opportunity to talk to everyone and kind of get some feedback. And yeah, we're really excited about this and going to wake up every day, kind of really looking forward to the opportunities ahead of us and some of the great partnerships that are coming up.
Fantastic. Actually, speaking of the getting up every day, sorry, Ryan, you reminded me of one last thing, and the difficulty that some of us have been having getting out of bed this past month and 5 days, I would say. Is there a specific way in which this fits in a strategy of saying, well, we've got some major problems at the federal level coming our way. There might be some local solutions that can work. Have you all been thinking about how this intersects with the peskier federal problems?
Yeah, so I was actually just in a strategy session Monday and Tuesday with a group of next generation civil rights activists that are thinking about that very question. I think one is what folks in that room were expecting to see is increased financial pressure on municipalities as federal funding becomes more discretionary at the state level, right? And so the sort of trickle down funds that municipalities depend upon, I think, are going to be less dependable as states get more discretion in terms of how they reallocate federal funding. And I think that's going to put increased financial pressure on those places. And so I think there's a real opportunity. There's a challenge and an opportunity. I think the opportunity is that I think increasingly attention from foundations, from folks that are interested in change is going to be focused at the local level. And so I think, one, I think that's the right lens. So I think that's where change happens in many ways. But two, I think there's a real opportunity to, as we're turning our attention to places, to really use this as a tool to deepen our analysis in that space.
Fantastic. Well, thank you so much for all the terrific work that you do. And thank you for joining us today and putting so much thought into this presentation. I think with a great audience and really a lot of interest and attention in this work. So we'll follow up. We can send out your contact information as well as the deck, if you don't mind, to the folks that have asked for it. Everybody, please feel free to get in touch also directly with me if you have any questions on this presentation, or in general, if you're interested in the work of the Transform Finance Investor Network. For those of you that are on the phone and not seeing the slides, my name is Andrea Armeni, and my email is andrea@transformfinance.org. So thank you so much, Micah and Ryan. Thank you to everybody who joined us today. Fantastic presentation. Much appreciated.